You said now you guys are buying all cash, so you're not going to be going to get funding. You're just going to raise all the money.
Yeah, right now.
Potentially,
Yeah,
okay.
yeah. Because what happened was the interest rates got high so quick,
True.
and cap rates. What you're buying these deals at, they were, say we're buying a deal, trophy asset in Florida for a 5.5 cap rate or a 5.25, 5. Debt's at 6%. So what happens is, we're focused on cash because that's what you want. That's what I want. That's what Grant wants. You want that drip every single month. Boom, right? Boom, 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 boom. And so what we tell the investors is, hey, you get 5 to 6% starting out. You get the tax benefits that offset that, so you don't pay tax. But if we go and buy these deals at a 5.5 cap and we put debt at a 6, it's negative leverage. So now you're getting a 4, 4.5, depending on the deal, right? And so what we found is like, okay, if we can go and buy them all cash, we can position ourselves. Number one, we're getting better deals. We're getting awarded the deals, and we beat out the competition because we have so much certainty because we don't have to go to the debt market and negotiate with them to actually close the transaction. Yeah. So it actually solves for a couple different things. Yeah. But the biggest thing it solves for is you could buy a deal for say a 5.5 cap, and you could give to the investors a 5% or a little above a 5, and so everybody's happy. And then you package all these together. And then when the debt comes down, because eventually the debt will come down, where does it settle?
Refi, everybody. Yeah.
You refi, pull the money out. It's a non-taxable event. You still stay in the deal. You still keep the cash flow, and you reinvest in that deal.
Are infinite.
Yeah.
And you're able to buy, like in this marketplace, you're able to buy better assets and beat out your competition because again, you're paying cash.
Yeah. No, that's a good point.
So when you say cash, you're literally just going to raise the full boat.
We closed the deal 3 weeks ago. It was almost 500 units in Plantation. It's called Jacaranda, Laurel's at Jacaranda. We paid $130 million plus or minus, all cash.
Wow.
So let's just say that's 100 for easy numbers. Normally, if that was what 2, 3, 4 years ago when interest rates were lower, you would have just had to raise 25 million. But now you had to raise $100 million or 130 million.
Yeah.
Wow.
Yeah.
When you're saying 80-20 split, it's 80% to the investor, 20% held by Cordon Capital.
That's right. Yeah. So on the profits, the lion's share goes to the investor, 80%. So if we sell, we make $10 million bucks. They get to split $8 million. We get to keep 2.
Got it. Okay.
Yeah.
That makes sense.
Which is actually, if you think about it, a lot of people, they get it really confusing with it. They do different tiers, but a lot of people are like 75-25. We used to be 65-35.
Got it.
But we wanted to make it super simple for the investor, where it's like, hey, look, because you guys got to think about it. We want to scale, right? So we're not worried about the nickels and dimes along the route. It's like we think that we can grow this thing big enough and get enough scale where the exit's going to be great for the investors and also for us.
Yeah. So for you to get to like 40,000 units, how much do you guys think you have to raise between now and then?
Well, look, I take it in a couple different tranches, right?
Yeah.
So we've raised already $4 billion, and we're controlling almost $5 billion, right? So depending on what happens, and we think like when we do all these deals all cash, when we refinance, we'll be able to pull that money out. Majority of the people are going to just reinvest and we'll go and buy more deals, right? But if when the debt market comes back down, I think over the next, you just say, just easy numbers. If you just double the portfolio, right? So $5 billion, you raise another 2 billion bucks. I think we can do it in the next 2 years.
Yeah, if you think about that though,
it's insane.
If the interest rates come down and you guys go refinance and you go to give all these people their money back, they're going to give it right back to you.
$800 million bucks.
So you guys better have something, a lot of shit lined up for them to buy, right?
Well, what happens
and
is
that's a beautiful problem. You're like, hey, here's all this money back. And they're like, well, we don't want it. We want the returns. Go out and find us more stuff.
That's right. Yeah. They want more depreciation. They want more returns. They want multiple assets. The thing that people are missing out the most is the relationships. When you're closing deals all cash, like the deals we just did, we built a great relationships with these sellers. So to your point, when we go and refinance these, like we're not only looking at single assets anymore, we're looking at portfolios now too. So it's like we can go and grab 2,000 units at a time, 3,000 units at a time, 1,000 units at a time. So these are the things that unlock when a lot of other people are on the sidelines because they can't get a committee to approve. And they just got different buckets, right? Like we've always been simple, multifamily. We have 2 office complexes, but one's in Arizona, it's our HQ, one's in Aventura, it's our HQ. But we've never gotten really super confusing to the public.